Dukascopy studio, and we're kicking things off with Dr. Frank Hollenbeck talking about the week's events. Frank, welcome back.
Hello.
Now, one of the interesting things at the tail end of last week was the Obama administration saying that they're keeping an eye on Japan to make sure that they're not devaluating the yen to a competitive advantage. Something we've been talking about for quite some time, but what was your take on this particular statement on Friday?
Well, as we can see from this graph, the yen was actually at 120 to the dollar and has actually appreciated until recently, and that's due primarily to the quantitative easing that we've seen in the United States, and only recently has it depreciated to a level of about 100 yen to the dollar. Now, when it comes to Japan, Japan is in a disastrous situation. In other words, even if it was to continue with its current policy, it's definitely going to go over the edge, in the sense that the current debt level in Japan is 1 quadrillion yen. You're going to say, what is the 1 quadrillion? That's 1,000 trillion. Okay. Now, it has revenues of 43 trillion, and it owes about 11 trillion in interest payments on the debt. That's about 25% of its revenues. Now, you have to realize that for a developing country, if it has a debt level 5 or 6 times its revenues, it's getting into trouble. In the case of Japan, that's 24 or 25 times its level of revenues. So we can see that ultimately, if it continues with this current policy, Japan is going to run into problems. So what is the solution? Well, instead of cutting government expenditures, the solution, according to the current government, is to spend even more money, okay, and to print an excessive amount of money. We have to realize that the QE that Japan is implementing is over the next 2 years is what the U.S. Central Bank implemented over 5 years. So it's a significant amount of quantitative easing. Now, where will all this money go? It's unlikely to go into the stock market or into housing, because from peak to trough, we've seen almost a 75% drop in the value of the stock market or in the value of housing. What it's likely to do is for the money to go into other safe assets, such as German bonds or U.S. government treasury bills. We have to realize that 95% of the purchases of Japanese government bonds are by the Japanese citizens, and 95% of that is by institutional investors. Now, one of the implicit assumptions in the Japanese strategy is that they're going to be able to raise inflation to 2%, but they're going to keep interest rates near zero. So in other words, we're going to have a negative real return. Of course, this is going to help them with their debt, okay, since they're the borrowers. But if you're a lender, in other words, if you're an institutional Japanese pension fund, for example, are you going to accept to get negative real returns? And the answer is no. Okay, so you're going to be looking for alternative safe assets, because that's kind of the Japanese character. But one of the things that is not being considered is, yes, they will be able to reduce the real value of their debt, but they have to realize is that they have to roll over some of that debt, and they also have to finance current government expenditures. We have to realize that over the last 5 years, Japan has spent twice as much that it's gotten in revenues. In other words, it has revenues of 43 trillion, it spent twice as much, so it has to finance that. So if interest rates, for example, were to increase to 3%, which would make sense given that we have 2% of inflation, then we can expect the entire government revenues to go to paying interest payments, and that can only lead to a catastrophe, okay, going over the cliff, as I said before. Now, I don't think this is a good strategy. It's been universally approved. I was actually surprised to see the IMF approve this strategy, since it's supposed to be there to ensure the stability of the international monetary system. But then again, the IMF didn't say anything when the US started quantitative easing, so it's not surprising that they would support this policy, even though it's likely to lead to currency wars, because it's unlikely that South Korea or China are just going to let the yen appreciate and not take some type of action. So for me, we're heading into dangerous waters. Okay, it's a bit that we have so many black swans in front of us. It's like we have more black swans in front of us than we have airplanes waiting to land at JFK Airport. So I'm really concerned about what's going to happen in the future.
Now, you mentioned obviously with the depreciation of the yen to competitive levels, it's obviously had a knock-on effect looking at the euro. There's a little bit of strength in the euro at the end of the liquidation put in last week. This obviously brings to mind the troubles that we have in Europe in terms of Cyprus, in terms of Italy. Cyprus is actually looking to loosen the citizenship worries or requirements to inspire a bit of confidence in the market. What is the situation here now? What is your take on Cyprus as we move into this trading week, Frank?
One of the things no one's talking about is why is it that Cypriot banks had so much Greek debt? And one of the things that we teach in portfolio management is the importance of diversification, so you don't have all your eggs in one basket. And the reason Cypriot banks had so much Greek debt has to do with the monetary policy that's been followed by the ECB since the inception of the euro. Now, the monetary policy was that the ECB gave out liquidity if you brought to it high quality assets. And these high quality assets were usually bonds with AAA rating. Well, what kind of bonds have AAA rating? Well, that was government bonds. So what it did is it induced banks to purchase government bonds, which lowered interest rates, and induced governments to issue government bonds. And in other words, if you're Greece and you have the same rating as Germany, okay, you're going to want to issue additional debt to pay for government expenditures. So what happened is government issued an excessive amount of government bonds, which led to an excessive amount of liquidity. For example, M3 was growing at 10%. Where the target was only 4.5% at the inception of the euro. And what this did is it led to the housing bubble in Spain and Ireland and to the sovereign debt crisis that we have today. The problem is that we continue to follow the same monetary policy in the sense that the ECB is giving out liquidity on government bonds. And that's why, for example, Italian banks and Spanish banks are holding such a large amount of sovereign debt. Well, what does this mean? This means that if Spain or Italy get into trouble, their banks are going to be in serious trouble. So we're going to, if we run into a situation where either Spain or Italy needs a bailout, the only option they'll have is to print money, and they'll have to do that by leaving the euro. So I can only see trouble in the future.
Gosh, it doesn't make for good news, but thank you very much for your insights again today, Frank. Pleasure to have you back in the studio. That's all from Frank and myself. There's plenty more to come from the TV team, so please do click back to DukascopyTv. Bye for now.